my name is Ville-Pekka Sorsa. I'm hosting the panel on investment-led recovery in Europe. And a couple of words about me. I'm university lecturer in political science at the University of Helsinki. I'm also the chair of Finnish Society for Political Economy Research, and we've been thinking about investments and the current, you could say, crisis in effective demand lately in many circles in the Finnish academia as well. So it's really a pleasure to be here. Thank you for inviting me here. I was actually planning the format a bit differently from what was the last introduction, saying that we should get some comments to the presentations from our two other panel members. But let's start with that anyway. So in the panel, besides Stephany Griffith-Jones and Markus Berndt, we have Vesa Vihriälä, who is the managing director of ETLA, I can't always remember how it is, the Research Institute of the Finnish Economy. That's what it is in English. And also Suominen, who is Political State Secretary at the Ministry of Finance. So I've seen you've taken a lot of notes, so perhaps if you'd like, you could first start commenting on, give a brief comments on the presentations, and after that we'll go to a more open panel format. But Vesa, would you like to start? I hope there's a mic and it is on. Okay. It is.
Okay,
good.
Thank you very much actually for the opportunity to be here and discuss these good presentations and focus on this important topic. I think it has become quite fashionable in Finland to make 3 points recently, so I will try to make 3 points. First, on austerity in Europe. I think in the first presentation it was argued that Europe is doing much worse than the US. And I don't know if it was an implication that fiscal policy has been tighter in Europe than in the US. Or something else, but if that was the claim, then I would argue that I disagree, because when we see difference in growth rates in euro area between the euro area and the US, it starts at around 2011. Until that time, the crisis was pretty much the same in these two regions, and when we look then at the sort of standard measures of fiscal policy stance in Europe and in the US, it actually turns out that the US has had tighter fiscal policy since 2011 than euro area, and by some margin. For example, it's not just Commission numbers, but the same result comes out when you take the OECD numbers on the change of primary cyclically adjusted primary balance, for example. So I would argue that if Europe has done worse than the US recently, it does not come primarily or at all from a different fiscal stance. Of course, then you need to have some other explanations, and I have a couple of ones in my mind. And one is, of course, that the US took much better care of their banking sector in the midst of the crisis. They were much more aggressive in addressing the problems in the banking system, recapitalized the banks, and did credible stress tests, what the Europeans did not do at the time. The second thing was, of course, that monetary policy has been looser in the US for a number, throughout the crisis, I would say, until recently. That's one explanation. Third one, perhaps there is some more resiliency in the US economy thanks to a more flexible labor market. And finally, of course, they have found some shale gas and oil, which they have made use of. It has lowered their energy prices, one thing, and secondly, it has spurred a lot of investment also. So that about austerity. Then I would have some other aspects on austerity, but maybe we come back to that a bit later. The second point on the investment gap, and I think it's quite clear that the level of investments have been lower in Europe now than not only at the peak of the previous boom before the crisis, but also lower than some years before the boom. So there's a decline in investment, and I would agree there is a gap. But how big that gap is not quite clear, because one can put forward arguments saying that some of this decline in investment level, investment ratio, overall investment in relation to GDP, may stem from secular factors, such as decline in the future labor force, perhaps, and which is almost sure for Europe. We know how the demographics look like in Europe, and we see that the labor force is declining, and that means that the potential output at a given level of total factor productivity is going down. And on top of that, it may be that also the rate of growth of total factor productivity in Europe as well as elsewhere in the world has declined. It is slower now going forward than what it used to be. And if this is the case, either of these factors are true, then the level of investment needed for a stable capital output ratio would be lower. Daniel Gross from SEPS, I think many people know him, has actually calculated that if we just take into account the change demography in Europe, or how it's going to change, that could, according to him, explain a decline of the investment ratio, so the steady state equilibrium investment rate by some 2.5 to 3.5 percentage point of GDP, which would be a big sort of part of the decline of 4.5 percentage point that the ratio has declined in Europe from 2007 until 2013. So I'm not sure that all of these 230 to 390 billion or whatever it was in one of the graphs, investment gap is true. It actually may be that some of that is something that cannot be replaced by any government measures, or should not be replaced. But I don't deny, I think there is a gap, and it needs to be addressed, and if you do it through the Juncker initiative, I think it's a very wise thing to do, because it's very cheap. If we have the 15-to-1 leverage ratio, I think it's money well spent, no question about that. So I'm all for the program, though I'm not 100% sure that the problem is as big as has been argued. And the final third point, and it is a sort of more general about the role and nature of private capitalist financial system. And I fully agree, it's prone to instability. As Kindleberger, Minsky, Keynes have argued, I think I fully agree. And one of the conclusions there is that you need to improve on it, and you can do it through better regulation, better supervision, sufficient resolution mechanisms which take care of problems. But still, I would argue that any government-sponsored entity would only have a sort of complementary role in this. It cannot replace this ugly capitalist financial system. Because in my mind, it is something like what Churchill said about democracy. It is the worst system we can have when we exclude everybody else, everything else that we have tried so far. Then finally, perhaps just, I mean, one point about Finland and the investment problems. And now, one of the arguments that was put forward here is that we need government action because the financial system doesn't function properly given the crisis experience. And as I said, I tend to think that is true in Europe in general, in some countries very severely so. But we have seen a decline of the investment ratio also in this country, while our banking system has been in an excellent shape. While the interest rates the Finnish companies have faced have been lowest, among the lowest in Europe. While when firms are asked how severe financial constraints they meet in the market when they want to invest, the Finnish companies report lowest fraction of problems of almost any euro area country. So I don't disagree that there can be, particularly for growth companies, which don't have collateral, they have problems in finding risk financing. But as a sort of general claim that there's a huge financing problem, financial constraint that has taken down our investment ratio, I would again tend to disagree. And I think this is also sort of piece of evidence which suggests that we cannot blame for the decline in Europe of the investment in Europe solely for the financial troubles. This is pretty much what I have to say to begin with.
Thank you. Can I just comment very briefly? I mean, like, of course, in Finland, one of the problems with the financial sector is that we have massive institutional investors. We have a lot of money to kind of stable investment. We also have pretty good system for startups and stuff like that. It's not really a problem. It's that we are kind of missing the middle in a way. So in a way, it's an institutional issue. We don't have this kind of investors that are small enough to make strategic investments in this kind of scaling up processes and stuff like this. So I think that is one thing that we in Finland need to think about. But Esa, please.
Yes, thank you. And thank you for our international guests for inspiring and interesting presentations. It was a pleasure to hear. Since Vesa was talking more about the European side of the presentation, so I will make a couple of remarks on the more focused on the Finnish situation. So I agree with Vesa here what he's saying about the funding possibilities, but like basically I think that why this topic is so important is that the investment to GDP ratio in Finland is historically low, and the trend is bad, so it's going down. And this is a very, very difficult situation since economically historically, the employment and then this investment to GDP ratio have been going in hand, and as we are witnessing also at the moment is that we are in a situation with the declining investment and rising unemployment, now getting up to nearer the 10% line. So this is definitely a big problem when you start excluding reasons. So it seems to be that this lack of investment is one of the key reasons behind like what is happening here. And Finnish companies do invest, but they don't invest in Finland. They invest abroad, and which is one big issue. And also the consumer demand back home, although the unemployment rate hasn't gone up as much as it used to go in the beginning of 90s, when the last time there was a big recession. It was steeper, but it was also quicker, since now the economic crisis is going to school already after 7 years. So although the unemployment rate hasn't been going up as steeply, but there's also reasons that the retirement is now much helping us statistically, but not in economically wise. So, and the lack of trust, which can be seen in the private market, so that definitely influences also the consumer demand and the will to take risk. Couple of points on as Professor Griffith-Jones was pointing out that it would be necessary for those countries in Europe with a relatively low debt to GDP ratio to invest more, to take debt and also invest in future growth potential. Yes, in a way, this is definitely true. It makes a lot of sense. Problem being that we are also committed to these EU rules, this golden rule, which actually is making it in a way illegal to do so. And of course, this is something which could be perhaps implemented, but we are in a bad road at the moment. There is a big sustainability gap in the Finnish economy in the long term, and therefore, let's say that even though many countries, Germany for example, like their debt to GDP ratio is worse than in Finland, but they are going down. We are going up. So this kind of limits our chances of actually going through the straight, let's say, like debt stimulus sort of way. So this bad future outlook is limiting our possibilities, I would say. But the question remains, what is something which this panel and this audience also, and I would be delighted to hear remarks on the fact that Finland has been going already with big consolidation during this term. So there's big cuts, big consolidation measures, but the sustainability gap hasn't actually even decreased. So there is a question, which I'm not posing here, but a researcher might pose, that is this self-defeating, that we are consolidating and we don't see anything happening. And the reason behind this decreasing situation and the growing sustainability gap in the public finances, so it is due to the employment outlook in the long term. But we of course have to then think that, okay, the potential growth is also, like now, since the unemployment is going up, the potential growth is going down, and the skills and the possibilities to employ oneself again. So it's getting harder and harder every day. So is this something where the consolidation actually is helping us or not? So this is an interesting question. Final remark before, like would be plenty of remarks, but just for the discussion's sake. So final remark about the Juncker plan. I completely agree with the both speakers that it's very important that both as a program itself, but also as a matter of changing the discourse. Changing the discourse towards investment and towards this kind of Europe as offering possibilities, starting something anew. So, and that the problems are not solved by austerity only. And so that we really need investment and we really need these, new projects and getting things going on. But naturally, this is something which is far from ready, though. There is a political problem here in the time of EU skepticism, strained public finances, that you actually are able to, convince your electorate that this is the time when we actually start taking more debt and put it to the European, like increase our national contribution, and then we will get the European investment going. This is something which is quite hard to rally home during this time of democratic process as we are. See, when there is a huge EU skepticism, for example. I'm not saying we shouldn't do it, but this is something which has to be taken into account, like how we actually can deliver more trust towards the European project as a whole. But these perhaps as a starting.
Thank you, Vesa. Actually, Stephany and Markus, would you like to comment back, or should we go to other themes? So perhaps you would like to. You already have the mic, so please go ahead.
Very, very briefly, thank you for very, very perceptive comments. Maybe I could start with the State Secretary's question himself, challenging us. He says, is the continued austerity self-defeating? I think I wouldn't perhaps put it so strongly, but my boss, Joe Stiglitz, talked about it once as a collective suicide pact. That if you impose austerity at the same time within countries that trade so much with each other, and we've done also some modeling in the past that shows this, how much damage is caused by this collective austerity. So it doesn't matter so much if one or two countries in the EU are doing austerity, but if they're doing it at the aggregate level simultaneously, they are depressing aggregate demand throughout the Union. And I think this is one of the reasons why Germany's actually slowed down remarkably, unfortunately. And even, I'm originally a development specialist, then the EU has a negative effect on the rest of the world, including the developing countries, the US, and that feeds back then into Europe. So we have to, I think, look at the direct and indirect economic effects. You say that you're constrained by rules, and of course that is very true if you're in government. But I think one has to at some point ask if the rules in the EU, which were designed in completely another context, need to be rethought. And I would say just two very brief things. One, the country where I grew up, Chile, has very tight fiscal policies now. We've learned from the past, from the mistakes. But they have a counter-cyclical fiscal rule. So although it's actually more strict than it is in Europe, because they have over the cycle 0.5% of GDP of surplus, it is counter-cyclical. So in good times, they have to tighten, but in recessionary times, they're allowed more leeway. So could one think more along those terms in the rules? And the second element is, of course, this golden rule, which the Juncker plan is opening a little bit. If you use part of the deficit to invest productively, then it's not the same as if you're just adding to bureaucracy and so on. Secondly, if I may very quickly, the first commentator made a number of very interesting points. I agree in part with what he said about the US. There were, of course, other elements, not just fiscal policy, but certainly monetary policy was important, certainly shale was important, and the fact that the banks were a much smaller part of GDP and were bailed out so clearly and quickly played a very positive role. I think also they're better at PR than we are in Europe because they have convinced the markets that the banks have no problems. I'm not so sure that that is the case, but that is the perception. On his point about the financial system, I agree with him that there are public government failures, but the problem, I think, in the financial sector is that often market failures are so large that government failures may be smaller. And that's a case, I think, for better regulation. But there is a problem that we have, I think, in Europe and the United States, is that there has been, because the financial sector has become so big and is such a large part of the economy, it has also become very powerful. And therefore, it's very difficult to regulate properly. And I think we have a risk, if we don't do this, that our competitors in other countries, like China and others, may have actually a more functional financial system, formally less developed and less sophisticated, but more functional. And certainly I agree with you that any government-sponsored banks would be complementary, not a substitute. And in that sense, I think the new plan is very interesting.
Well, I'm not sure if I can add much. I just wanted to say very, very few remarks then. Regarding the EU, the euro area versus US differences, I think one thing we have to acknowledge is that there was also an EU dimension to this crisis, and we realized that we were lacking certain institutions to back the monetary and economic union. So I would like to add this particular dimension to the other policy differences and policy responses, which I agree with. But I think it was, I mean, to give us some credit, it was not. We had to establish the banking union, ESM, and there were a lot of reforms that happened that were unthinkable just a few years before. Regarding the argument of Daniel Gross, and I think it's a very, very important one. We just had a conference with him and we were discussing all this, and there's some conceptual questions you can raise regarding his model, because he's using only potential growth, and then potential growth has all these problems. But just on a very high level, the point, even if you have declining labor force and a shrinking population, that doesn't, of course you need investments, because, I mean, just because maybe you have an oversupply of highways doesn't mean that you already have an oversupply of broadband. I mean, the type of investment and rehabilitation. So, but this is a point fully taken. We cannot just, we have to take this into account and adjust whatever estimates we have. But the numbers I was presenting were explicitly bottom-up and not top-down. So we were looking at every sector and thinking, if this is our target, if this is our benchmark, what would we need to reach that frontier? And of course, there's an interdependence, and not all of these variables are, there's indigeneity between the variables. So I'm not claiming that the gaps I was presenting is is like the gap for every single one to social optimum, is the gap to the frontier. If Europe were serious in becoming the leading economy, as we some time ago claimed in Lisbon, then what would be the investment needs? Well, I reiterate the point that a governance-sponsored entity should only be complementary. Maybe adding that complementary, and that we think that our role is actually going to be declining over time, because right now there's a transition from one system to another, and that will take a certain time. And I guess our role, maybe 10 years from now, we would hope we would have even less of a role, because the need for supporting transition would go down. And then I wanted to just make one, obviously I didn't want to comment on EU rules coming from an EU institution, but I wanted to make one comment on the political feasibility. Well, I'm not sure if I should be commenting on that either, but I think this is actually the chance for us Eurocrats or pro-Europeans to sell to the society that Europe can do something useful. And and that's kind of one of the rationales of saying we're not asking for, even if we don't get any additional member state funding, even if we just rely on the budget as it is, by shifting a little bit, by doing as much as we can with the little resources that we have, I think it's our chance to actually sell is a bad word, to convince our fellow Europeans that there is something worthy in Europe. And that brings me to the last point that I just forgot. Why did Finnish investments go down? One reason is because of these interlinkages, right? Finland's just investment, I mean, you are less convinced to invest in Finland just because you have all this uncertainty about the euro, the monetary union that Finland is a part in. And that's exactly why a European response, policy response, makes sense not only for Greece or Spain or Ireland, but also for countries like Germany or Finland. Thanks.
Vesa wanted a small one. Take the mic.
Sorry. On austerity and fiscal policy in Europe, I agree that the aggregate fiscal stance could have been more expansionary in Europe over the past few years. And then, of course, Germany should have played a more active role in this regard. There's no question about that. It would have been good for Germany. It had been good for Europe. Although, I would also argue that, at least on the basis of those simulations I have seen, it would not have helped Greece or Portugal that much because of these problems were too serious on the one hand, and because their dependence on German demand, for example, through exports, these traditional trade channels have been small. Relating to this, I think Germany should have done more. Actually, Finland has contributed, I think, its share in expansion. As I said, that we have been tightening a lot. From bottom-up calculations, that is a result, but when you take top-down analysis, what you typically use in these contexts, then actually our fiscal policy has been, if they take a cumulative stance from 2009 to 2014, one of the most expansionary in Europe, in fact. And it stems from expansion in the beginning of the period and more or less neutrality since that. So it is a bit difficult to argue that we had consolidated a great deal, or that it had caused our troubles in Finland. And I think it is quite visible also from when you look at the individual demand components. Consumption has done quite well in Finland. Of course, it has been flat now over a couple of years, but overall it hasn't declined. What has been doing very badly is exports and investment, as we have discussed. And my argument is that this is basically because of bad export performance. Part of that comes from the fact you mentioned the sort of crisis elsewhere in Europe and elsewhere in our export markets. And part comes from our specific idiosyncratic risks, which we are materialized, Nokia and that stuff, which take certainly a lot of time to address. But part of that comes from our bad competitiveness, so traditional cost competitiveness, because of which we haven't been able to replace the lost production, which never comes back as such, with other production. And I think what you said about Finnish companies investing abroad rather than in Finland, I think is indication of the fact that it is not a problem of the companies themselves being financially constrained primarily, but that Finland is not attractive enough for investments.
Actually, I want to briefly comment on that because I think that about your first point, I mean, like saying that, look, we have been providing stimulus basically because we have a budget deficit and so on. But then again, I mean, isn't that due to automatic stabilizers basically? No?
I wasn't referring to automatic stabilizers. In fact, I was referring precisely to the discretionary part of fiscal policy or the deficit. And on top of that, of course, we have had a significant automatic stabilization.
Yeah, but then again, if you go back to the earlier points, wouldn't it be that in the US actually, because they don't have public automatic stabilizer in the same extent, then you could say they have been actually more aggressive in discretionary revitalization. I would argue that in a sense. So in a way, the earlier point kind of
I have to come
would
back to
become
this.
invalid.
The US has been tighter on fiscal policy when it comes to discretionary measures, and then they have had weaker automatic stabilizers.
Yeah.
So the fiscal impulse as a whole has been definitely weaker in the US since 2011 than in the euro area. That's my claim.
Yeah. Can I
Yep.
just I mean, I haven't studied this in depth, but I think that my impression was that, particularly initially, I think the fiscal impulse was important in the United States. It was very important, and I think that's where the stimulus comes from. I was particularly actually being critical of German fiscal policy because Germany has this current account surplus of 7.5% of GDP, so it has that space, it can borrow cheaply. Okay, its debt to GDP is quite high, but the markets are very willing to fund its debt. So I think, and I think in that sense I don't agree so much with you. I think more rapid growth in Germany could help even Spain or Greece because you would have more German tourists going there. So it's not maybe so much on the goods side, but it's more on the services. So there has to be some spillover effects from that. And so I think in that sense, all of us, except German finance ministry, agree, I think, in Europe that a greater fiscal stimulus and indeed higher wages, which are beginning to happen now in Germany, but they were for a long time very low, have held back growth, not just in general in Europe, but also in Germany itself. There was some more space.
Okay, I'm one of those people who really don't care if the investment is public or private for a variety of theoretical reasons I won't go into right now. But I think that the key issue today is that we actually need investment to get out of this mess, if you like. I mean, that's the point, whether public or private in a sense, because otherwise this kind of crisis in effective demand will remain, and it's really difficult to see a way out from here. But then it begs the question, what kind of investment? What kind of investment? That's of course the key point. And so what about Markus said that, yes, we need to show that the EU institutions and the European project is actually worthwhile, then we can also think about, well, perhaps you need to be concrete, and you've given in your presentation a few points that might be interesting. But actually I'm going to direct this one to Stephany, because you were saying that, of course, all the projects that are funded must be good projects. And what Markus said before is that, well, we don't need more highways unless there's traffic, unless they actually contribute something, stuff like that. What are the good projects? What do we need to invest in at the moment? Please, everyone in the panel. But perhaps I would like Stephany to start, because you mentioned the good projects term.
I'm not really an engineer. My theory is that we need more engineers in this world and less financial engineers. But I think there are people who see that Europe can benefit from having quite a different technological challenge brought by this green economy. The green economy is not just good for the planet, but that it could also generate a number of direct and indirect effects through renewable energy, through change in lifestyle, giving more weight perhaps to healthcare social care, which may be to digital aspects, then I wouldn't argue this in the same way, I think, for developing countries, where there's still a lot of basic needs, if you like, to be met. But I think in our case, we need a fundamental transformation. It's maybe we don't need new roads always, but maybe we need more public transport and less private transport, so that our carbon emissions per unit. And by the way, I think the EIB is very good on that, because they actually give a shadow price to carbon in the evaluation. So they are already having a bias against, if you like, carbon-intensive projects and in favor of low-carbon projects. So I think there is a whole range of investments which could be carried out in that kind of area. And I think we also need somehow to look at projects that generate more jobs. Because a major weakness now in the European economy is this incapacity to generate jobs, particularly for young people, especially in the South Eurozone, but even here. I mean, when you hear these numbers about, maybe they're a bit exaggerated, but I don't know how much, 55% of young people are employed in Spain and in Greece. Even if it's just half, I mean, there is a bit of a sense of lost generation. So things that are labor-intensive, I think, should also have priority.
Yes, there are a few things beside youth unemployment that becomes more expensive in the longer run. So, Esa, so what are your investment targets?
Investment targets, I would say that since there is definitely at the same time need for more investment and sort of a stimulus, but at the same time there's a big need for structural reform, since that gives room for, let's say, this kind of fiscal policy also. And what comes to the investment is that I would be going for projects which actually are good for the employment in the short term and good for the public finance in the longer term. For example, like, can we actually invest to something which is contributing to the let's say future savings in public services, for example. And if taking example from Finland, for example, so that public spaces, schools, healthcare centers, daycare centers, many of them built in the 70s. Huge piling depth of, repairments not being done. It's going to be expensive. They are unhealthy. They are in wrong place since the people have been migrating to bigger cities, and worth billions of euros to repair these places to a situation or to a condition which is, healthy. And let's say, for example, or schools, for example, to, let's say, to face new pedagogics, where it isn't just the teacher is standing in the front and everybody is listening. So what actually could be a good investment in the short term would be to replace these old, unhealthy buildings, for example, in schools, in healthcare, in education, and decreasing the amount, but building a new one. Let's say that close 3 build one new, which is then, up class, all ICT, renewable energy, as a reference point for those companies who provide these solutions. So this kind of investment would be both reasonable in the short term as an employment-wise and reference market-wise, and would save a lot of public money in the long term and provide better services. So this is some kind of investment which I would be going for in Finland. In European scale, perhaps as Professor Jones was saying, that the renewable energy perhaps offers the biggest possibilities, since it's both, let's say, environmental issue, it's a job issue, it's also a security policy issue.
But if we start to think about this kind of ecological modernization projects and things like that, what I see at the moment is that all the investment initiatives are kind of pretty much business-based. And I mean, if you want to build a super electric network, what is called super network, I mean, like, which can have sustainable kind of renewable energy in them, and all kinds of different types of energy coming into that is something that the markets won't ever build, if you like, in a way, I mean, like, but still, I mean, the sums of money that are put in this project are not nearly as big as they should if we want to do these kinds of projects. That has to be something like $1 trillion or $2 trillion in order to build these kinds of networks. So I'm kind of wondering, I mean, like, there's a lot of talk about this kind of new kind of green investment paradigm and stuff like that, but I don't see the actions. Why is that? Is there no political will, or is it just a lack of imagination, or do you have any idea why that might be? Vesa.
I don't really know for sure, but I think one of the issues is that it's so difficult to determine what is actually profitable and useful investment in the long term. I mean, we can easily say that it's very like the clean tech in the broad sense of the word is something to go for. I mean, it seems quite obvious. But what precisely is there that now the government should do? What comes to my mind as a sort of principle is that it should have strong externalities. That is the key element. And then what one thinks, for example, is that some pilot plans, when you have to experiment with new technology, that is something that perhaps the private sector cannot or is not willing to take risk on. So you need to have some encouragement on the one hand, risk sharing or something from the government side, which makes it possible. Then also, I think referring to what you said about sort of network things, where you clearly have externalities and where perhaps the individual private entities are not willing to participate because they don't get any benefit themselves. What they are, I don't know, scientific infrastructure certainly is such a thing, and there we could do something. One thing right now, I think this year in the short term in Finland would be repair roads. Oil is cheap, which means that putting tarmac on roads is cheap as well.
Talking about green investment there. Yeah. But I mean, yeah, Stephany, please.
There's just one small thing. I think one way also of saving public money in the future is this idea that the state should, as the previous speaker just said, try and put money where the private sector doesn't want to go, including possibly subsidizing where necessary, but then getting the return. So if the project goes really well, then the public sector gets a proportion of the extra return, which is a sort of equity-like thing or contingent debt. I mean, private sector doesn't always like it, but if they want, the additional stimulus initially, then you protect the public budget, because I agree that in the long term we want to have sustainable fiscal policy. And then, of course, you can use the money again for new pioneering investment, and then the state can pull out. So I think if we have this kind of perception, and also the point that Markus made, which is important, to have a kind of counter-cyclical role for state investment. Now we need more because the private sector, after any crisis that I've ever studied, doesn't want to invest. But then later it should withdraw. So you have to have this kind of dynamic, I think, sense.
Yeah, Markus, please.
I'm not sure if I can add much as the last speaker. Just as a general remark to your introductory statement, you don't care whether it's private or public. We have to be aware that most of the investments, the vast majority will always be private. There's no way for public to replace private, and for good reasons. So that's why we will certainly, and as Vesa was saying, concentrate on those where we think we can generate the greatest external effects. And now, concretely, where do we see that? Well, first of all, the EU is a very diverse economy, so that will be different in Bulgaria than in Finland, and different in Spain than in Poland. Certainly, I think if we look at these gaps that we were looking at, I think the gap in R&D and tertiary education is very worrisome if you want to be a leading economy, because you can only grow once you're close to the frontier, you can only grow if you come up with new ways of combining your productive resources to provide services to the society. And then, of course, given that we are an economic union that is still not a full union, I think all networks are very, very important. And that includes, in some areas, probably still things like roads and railroads. But it's also that what's, I think, growing is urban infrastructure, because a lot of growth is happening in urban centers. And then things like broadband and especially data centers, where, for example, Europe is very dependent on American and other providers, whereas it would have the society itself, the European society would have an interest in having its own resources in terms of data centers and broadband. So those would be very concrete things. But in general, every single project will have to be assessed in terms of its economic rate of return, and that should be significantly higher than what can be captured by a financial investor, because otherwise the private investor would just invest.
Let's hold that thought about the RDI investments and things like that. But at this moment, it would be nice to open the floor for the audience. If you have questions, comments you'd like to give, now would be a very good time to do that. Is there anyone? Yes, please. There's a mic coming.
Hello and good afternoon. Miika Kurtakov here. So I've recently read a number of studies on the long-term estimates and trends on the demand of human labor, not just manual labor, but human labor that will be replaced up to 80% or more by robotization and or artificial intelligence, which means that the demand, or actually there will be huge surplus of people in the labor market, regardless of the increase of people in retirement. So how do you see that situation in Europe, and what do you think would be the best cases, and as said, not just short term, but going 5, 10, 15, 20 years from now on? So how could we tackle this?
Excellent question. Does our panel have any answers to it? I hope you do, because Esa was one first.
Yeah, thanks, Miika, for excellent comment or question. This is a very, very important topic. Well, naturally, it's hard to predict, but anyway, in a way, in history, there has been these disruptive technological innovations before also. It hasn't been, many, it hasn't been centuries since, hundreds of thousands of Finnish men went up north to the forest in the middle of the winter to chop down wood. And then somebody came and invented a chainsaw. And more or less that business went broke. But that didn't mean that although that kind of way of living was quite quickly depleted, so it didn't mean that there would have been mass unemployment. Of course, there was there was some unemployment, but then people eventually found new places, and historically wise, this technological development has been for the better, and actually this unemployment problem has always been there. But this is definitely something which has to be taken into account when we think that now we consider that the service sector will save, industry will get automated, but that's okay since we always that we can always find jobs in restaurants and hotels and all this kind of service jobs. So this will definitely be automated too. I'm an old warehouse worker from a supermarket, and 80 people working in that big shop where I was working, half of them in the cashier. Okay, now when you have an automated cashier and a bank card which can be read, so you can rationalize half of the people. So of course there will be a big problem here, but I'm pretty confident that there are perhaps the private sector also gets more, effective in a way, and the profitability rises. So it's then much more about the fact that can we extract value and can we extract income from this, enhancing private sector so that we have a chance to employ people in, in these kind of professions, like, for example, in care and issues like this, which are not so easily automated or robotized, at least in the short term. But of course, there's million things here, but an excellent comment.
They're trying to do that at the moment, like in elderly care. They have different kinds of robots going on. That's pretty frightening. Does anyone else want to comment on this robotization issue? Actually, I noticed Etla produced a report a while ago where it said that, was it like 1/3 of economists would be replaced by computers? That is quite interesting.
If I may respond, actually we came up with sort of analysis which was a repetition of what the British economists did on American data, and we came up with a slightly smaller number of those jobs which will disappear very likely in Finland, 1/3, and they had 47% or something like that for the US. But we got some messages from people then saying that perhaps 80%, 90% of economists should go. I think I very much agree what Esa said about the disruptions we have seen in the past, and people have been many times desperate about where to find the jobs. And I'm not so completely pessimistic. Of course, there will be something new, but it may be more difficult this time around because the change is so radical, so big. And for the Nordic countries in particular, I think it is a great challenge because our societies are based on the idea that a large part of the population take part in the labor market, support themselves and provide tax incomes for the government to provide for those who can't work. And now when there is this sort of hollowing out of the labor market, that the middle quality or middle technology level or middle jobs are disappearing, it is a very big challenge for the Nordic societies. And I don't have any good answer, but I think this is the key issue that we have to address.
Okay, there was one other question. Okay, yeah, sure.
Just very quickly. I mean, it's not really my field. I just wanted to a little bit make a joke that one of my first lecturers in Chile said that there will always be a demand for economists because if things are going well, they have to contribute to the economic evolution and explain why things are going well. And if things go badly, the economists always needed to explain and debate why they're going badly. So I think we're going to be safe there. But more seriously, I wanted to say, well, first, there is this point about the past, that there's always been this scare, and will this be so different? There's another point which I think is very complicated, but Keynes said and wrote in one of his books, papers, and Skidelsky's written a book about that, arguing that if we have an increase in productivity we could perhaps have more leisure. And I think the transition to that would be, of course, very complicated because we have to have higher levels of productivity to compete internationally. But if we can manage this transition, there may be some opportunities there. But it has to be done skillfully and not at the cost of productivity.
Yep, a big question about distribution. But then, please, there was one in the back row, and then next one from there.
My name is Timo Karjalainen. Thank you for your most interesting discussion. From robotics, I thought that put a question. Do you think that it is possible to put a follow-up system, for example, for the plan of Juncker? What has really happened with this plan after a few years? I mean that perhaps the ICT technology, robotics, artificial intelligence have developed so much that it is possible to put up a very sophisticated system which give us information about the results of these projects. Has it really happened so as we now think or plan to happen? Do you think that it is possible to implement new technology in these kind of projects.
So can we replace the economists with robots when it comes to the follow-up of a Juncker program? But I would like to actually, this is an interesting thing, Markus, can you tell us about the follow-up kind of plans you have in the Juncker program?
Yes and no. Yes. Well, the same concern is that the European Parliament and the Council and the Commission have the same concern. So the regulation, as it currently stands, foresees very detailed evaluation of this program as we go, and then also at the end. I have to be. Well, as I said, this is moving target. The regulation is currently being discussed by the Parliament, but currently it foresees an evaluation for every project. We would have some kind of an estimate what we think this project is contributing. Then every project will be monitored, and then there will be a midterm evaluation of the program, and then at the end of 3 years, and then later on, another evaluation of the macroeconomic impact in terms of growth and employment. That said, this is still a moving target, but I think you can it's very difficult to attribute every employment impact, especially the indirect one, to single projects. But you can already. There is technology there and models and some economists out there that can come up with reasonable estimates of what has happened, and we're committed to evaluate and to learn from this. I mean, like every public intervention, and we had we want to learn, and ideally we want to show that this worked, because then maybe we learn something for the way forward on how to use EU funds going forward. So yes. But there will always be economists running these programs. So in terms of economists, employment should be okay.
Yeah, someone has to program the computer anyway. So.
Exactly.
Okay, there was one more question in there. Do you have a mic there? Yep, it's coming.
Thank you. Thank you for the presentations. My name is Tapani Kaskela. I'm one of the 80% of the economists that already have become obsolete, being a senior citizen now. Most of my life has been in the financial sector, so my question brings us back to the Juncker plan and the EFSI and Finland. In fact, I'm not so much concerned about the rest of Europe at the moment. I very much like what Vesa said about the financial situation among Finnish firms and the access or the constraints to finance, which don't seem to be acute in the Finnish circumstances. I'm not speaking about Southern Europe or other countries. So, I mean, the EIB has been doing a good job with the major companies, with the public sector, EIF with the private equity sector. Even though some years ago we used to say that there's a lack of venture capital in Finland, but that has changed recently. When I talk to private equity people, they said, no, it's not a constraint. I mean, if you have a good project, it will always find a financing today, equity, debt capital, whatever. So maybe the Juncker plan relevance is not as big for the Finnish private sector as it may in some other countries. Of course, in the public sector, we have a backlog of overdue investments in the deteriorating infrastructure, as was said by Esa, schools, roads, what have you. And there might be a role for the EFSI in improving those sectors or subsectors. But my question really is, what is the additionality and the what added value does the EFSI bring to what the EIB already is doing? Wouldn't it be easier to just raise the capital of EIB and bring in the same funding, the same leverage from the private sector as you're doing already now? Is it just the political factor that is highlighted by the need to have something new and show the PR effect of the European Union doing something new? I mean, you have the capability, the human capital in the institution, and why not just increase the capacity? And of course, following this, a new institution would have to develop its capacity, its ability to appraise investment projects, which doesn't come overnight. I mean, you need to build it up over time. So that's basically my question.
Yes. The additionality of this, and could be done with a capital increase. As I pretty clearly said in my presentation, it has the same effect as a capital increase. So yes, in that sense, you could have had the same effect with 21 or 16 billion capital increase, and then you can do the same. But I think it goes beyond that. First of all, the 16 billion are not coming from member states, right? So it's coming from the EU budget. So that's different. It's an EU level kind of increase without putting any extra burden on the member states. So that's one difference. And as you pointed out, there's also the political difference. I think this has triggered an even stronger cooperation between member states, the Commission, and the EIB. So we would hope that this is doing something new. In terms of the projects that we are intending to finance through this plan, there is a difference, because if you remember the capital increase, we clearly had the ambition. Well, we had a clear guidance from our member states to lend a certain volume of lending. So we were restricted in the risks that we could be taking. Under this new plan, we have much more flexibility and can take much higher risk, because we're not obliged to have a 6 times internal leverage. We can adjust the projects, the type of products that we offer and the projects that we invest in according to needs, and we have more flexibility. So there is certainly a new element in terms of what we bring to the market. And I don't want to predict what you didn't ask the question about Finland, but I think in Finland, one thing, R&D investment, for example, there are some that can be financed through venture capital, and I agree that also with the other remark that access to finance is not as much a problem in Greece as it is in other member states, right? But as I've also shown, R&D investment have gone down in Finland. At the same time, there is a great potential of there's the knowledge is here, so there might be that some R&D, some research. That is not viable for a normal financial investor, but has the economic rate of return that makes it useful for the EU as a whole, does take place in Finland, and there it would make sense for an institution like the EIB to engage in Finland, because because this wouldn't be addressing the normal access to finance problems. This would be addressing the fact that you need some kind of public investment for that type of research to happen. I hope that's answering your question.
Yeah, but then again, I mean, like if you look at the funding, correct me if I'm wrong, but they've actually taken a lot of money away from the ERC and the Horizon 2020 program, which are actually the kind of things that you might establish infrastructures
Well,
with.
first, I just want to. Yeah.
No, this is exactly, just a little footnote, but I think you're the best person to answer. But when I said in my presentation that there was there additionality, that's exactly what I meant, that the money was being taken from other programs within the EU budget. If you had, for example, a capital increase, as you said, member states would have had to put additional money in. And of course, they don't want to because they're heavily indebted or think they're too heavily indebted. But there is this problem, I think, of additionality. But you're the boss on this one, you know.
No. I was going to say that the one to decide that is the Parliament. That's the authority on the budget. I think we will have to wait for the outcome, because that is one of the most heated discussion in the Parliament. As I said. For us, it's 16 billion fresh money coming from the budget because we have that guarantee. But there is a need. There's a financial need, but also a political need to put some provisions up there. And where this is coming from is going to be something that's discussed. And I don't want to preempt the outcome of that discussion. But in some, what I want to say is that for certain areas, for certain investment, for example, the commercialization of research. sometimes the shift from one instrument to the other can be beneficial for that type of activity, because you can, if you don't give subsidies but you provide loans for that investment, you have different incentives, and you have a rolling fund, and you can actually support more with the same amount of public money. But that said, of course, there's other activity like basic research, for example, by some institutions that don't even have the legal personality to take a loan from the EIB, where this has a distributional effect, and this is something that I don't want to comment on, especially not now where the Parliament is discussing that. So, but that's where some of these concerns are coming from, and that's understandable, and we will see what the political. What the outcome will be, but it's discussed as we speak very much.
So after all, it's always about the quality of the investment in the sense, and we have to assess that very carefully. And
yes,
of course, we come back to the follow-up question there. So.
Yeah, but it's also, I mean, different type of public intervention makes sense for different purposes, right? Yeah, so sure. Some type of public intervention cannot be done through loans, and we have to accept that. And others can actually might be even more efficient to do it through loans rather than through grants.
Okay, Vesa. And after that, we'll take the last question.
Actually something that makes me worry about this thing now that I heard about some of the things, investment objects that have been mentioned. Schools, urban infrastructure. What would be the European value added in that? One might think that those are pretty much national, even local infrastructures that we are talking about then. And then a sort of natural thing would be that they would be locally financed by public sectors locally, or preferably, of course, for when it comes to urban infrastructure, that the private sector would fund it through one way or another. We have instruments here, and we can improve on them, for example. Somehow I would think that if you have a European system, that would have to have a European value added. So it should concentrate on those things which individual member states wouldn't set up themselves, say energy grids across the borders, or, for example, or some scientific infrastructure which is so expensive that no country, not even Germany, would like to finance itself, that sort of thing. I don't know if you want to comment on that.
Oh, yeah. Yes, I think. Thank you for the question. Well, first of all, urban infrastructure can be if you have a road that helps. I mean, not only a highway between two countries is adding to the trans-European network, but also the road that helps you cross, let's say, Luxembourg, for example, because if you then get stuck in traffic, if you go from France to Belgium because you can't get around Luxembourg City, then that urban infrastructure is adding. But in principle, I agree. I just want to point out that us being an economic union, it is not the case that all the investments that happen in certain member states can have a significant impact on other countries, and it's not always very clear cut what is a purely local one and what is not. And if certain investments cannot take place in certain countries because they don't have the space, then it could be a European interest to do so. But all that said, your caveat is noted, and in fact, every single project we will have to show the EU value added of that project. But that does not, sometimes, as I said, sometimes even an urban infrastructure can have an EU value added. It also depends on the size of the country. It also depends on, where that is, but there's some capitals are very close to the borders of others, so it's not always very clear cut whether this is a purely local impact or has cross-border effects. But yes, I think it's very important to point out that we do look at EU value added.
Local can be cross-border too at the same time.
Yeah, and my point also about I was talking as public investment in general, not as as the region, as part of the European fund also. But yeah, Finland was proposing, for example, to this task force work projects concerning renewable energy and energy grids between Finland and Sweden, for example, and transport networks, which are part of the TEN network. So kind of looking for this European value added, and that's definitely has to be, if it's a European project, European fund, so it has to have this European viewpoint in there. But as Tapani's excellent question, I would say that Markus gave a very, very good, detailed answer to the question. But like me coming from the political side, so I would also comment that in a way this makes it also possible, since we are facing the rule, and we are facing the situation where we actually have the 60% and it's closing in. So this is a way of actually, when everybody sees that we need more investment, everybody sees it. But at the same time, there is no political will to actually make the rules more flexible. So creating a vehicle like this makes it possible to a little bit maneuver, to be honest.
Okay, the last question from the audience. Sorry, this is the last one. You had your hand up and oh, no. No, one. So yeah.
Yeah, my name is Antti Arnion. Okay, this is the last one, but I have been during the last times I have been thinking about this. Are we raising again, facing again a new financial bubble? It seems that all the investment levels are so low in Europe and here in Finland, private investment levels, and stock exchange rates are rising all the time. That are we really raising a new bubble in financial sector here in Europe?
Yeah, there is some capital market inflation going on as well. So what do you think? Is there a bubble building?
If I may start, so I think there's a risk, but I don't think it's an overwhelming risk at the moment. And given the choices, sort of deflationary tendencies in the economy when it comes to activity and also consumer prices, I think it is a risk we just have to take. And I thus support very much the position of the ECB currently, that they are expanding these purchases. But at the same time, of course, one needs to have some vigilance, be worried about that. And then in principle, we have tools to address that, the so-called macroprudential instruments, though one has to be rather careful how much leverage they have, actually. Sweden is a good example. There's been a huge debate in Sweden about what to do with the monetary policy. And the central bank has been claiming that these macroprudential instruments haven't been used to the full extent. And they are very unhappy about that, and they have been then blamed that they have been causing part of the trouble and all kinds of difficulties. So my answer to you is basically there's a risk, but we just have to take it.
Yeah, and we have to always remember that again, Europe is not one in the sense that in the Netherlands with the kind of the housing bubble kind of burst already. They have private debt is very high. Then again, if you start to think about Germany, well, that doesn't exist the same problem in the same way, and so on. Every country is different in this sense, so it might be that there are bubbles, but me too. I believe that we can avoid a kind of a massive bubble, especially if we kind of increase the effectiveness, how the channel actually finance to real investment, then at least we can do that.
Yeah, exactly. I think your point is very well taken, that to the extent that you have initiatives like the Juncker Plan, where you channel as part of this money into productive investment, then the chances of bubble diminish. But I also completely agree on the importance of macroprudential rules. It's very clear that if Spain, for example, had restricted lending to property, the property, they actually had macroprudential rules, but didn't apply to the real estate sector, which is like amazing and amazingly silly. And therefore, then they had this bubble. The same in Ireland. So if we have learned, I'm not so sure we've learned enough, because I live in England, and property prices in the southeast have continued to go up. It's complex, but I don't want to go into the detail. But I think they haven't applied macroprudential enough, and so I think that a combination of channeling the resources to more investment projects may reduce the tendency to bubble. There is a view that argues that even in the times of Greenspan, they used to talk about the Greenspan put, that every time we have a crisis, we throw monetary policy at it because we run out of tools. But that then we are, as you point out, maybe planting the seeds of the next crisis. And I think no economists have an answer to that.
Okay, now we are running out of time. I would only like you to give a last round of brief comments to a very difficult question. Okay, if we all agree we need more investment, real investment, what would be the first step in promoting it? What would be the kind of effective first step you would take in promoting investment? And let's start with Markus, because you're the kind of the practitioner in this front. What would you start with in promoting investment in Europe?
How to restart investment? Is that what's the most important?
Yeah, I mean, like, what would be the first step you would take from now to actually promote investment in Europe? Well, what would you change, or what would you add if you had the possibility to do that? What would be your first step?
Okay, I guess I have to say that this Juncker plan is the first step, but I think the first step is confidence. I think we have we did some research about a year ago, seeing what's driving investment, and the most significant variable, or the one with the highest coefficient, was investor confidence, and I think we've come a long way, but I think we still have to show that we believe in Europe and in the institutional setup that we have, and address all concerns that we have, because as I said before, we can address certain type of investments with initiatives like this one, and we've shown in our study, or we firmly believe that there are areas where you need these investments, but the great majority of investments is private investors, is private investment in private investment goods that generate returns, and you only invest if you are confident that this is the right place to invest to, and the European Union as a whole has become a net exporter of finance, whereas we were balanced only very recently. We're now exporting financing, and that's because this confidence isn't there, and I think the confidence is the most important.
So let's not summon the confidence fairy, but actually have confidence in ourselves.
No, but have confidence and address the institutional impediments that we still have to generate that confidence.
Great. Stephany, what would be your first step?
It's a key but difficult question. I think I would follow the line that Markus started, in the sense that we need to encourage private investors to feel that it's worthwhile to invest. I mean, I have stressed a lot the element of having sufficient aggregate demand, because I've studied crises in a number of regions, in developing countries and so on, and this problem always arises after crisis, that people are nervous about the risks, and they're worried also about the returns. So the financial sector, but also the companies, the non-financial companies, are nervous about investing when they've just had such a bad experience. And on top of that, if there's lack of aggregate demand, it seems less profitable. So I think restoring aggregate demand is an important element. So that's why, even though I think that high levels of debt are not a good place to be, I think that restoring aggregate demand is more important. But I also think that the confidence in Europe and in the euro is very important, because you see now this nervousness about the conflict between Greece and its creditors and so on, again eroding confidence. So strengthening, I think, the European institutions, strengthening the way forward is equally important.
So it has to be European level. Vesa.
Well,
some election work going here as well for your party too. I would imagine.
I don't know about, like, let's put it this way, that one thing which I would find important is that we would have a way, or we would have a chance to a little bit, how to say now, when you have public investment or public expenditure, that you could actually actually, make a difference between investments which actually you can prove that bring growth and which are reasonable to do also economically wise from the normal daily expenditure. This is naturally, very hard thing to do, but in a way it's necessary. Since in a situation where you can't do an investment, although you could see immediate gain. So this is something that if your rule book is so strict, so this is actually hindering economic growth. So this is perhaps the one thing. Of course, there would be plenty of things, clear missions, in regulatory wise, in the spirit of Matsukato and things like this. But I would go for this first option if you ask for one thing.
Well, you could also argue that if we look at the kind of business, the winners in business nowadays, I mean, every single one has at some point enjoyed massive public support. So I don't think that would be hard, but I know the Finnish political climate especially, it is quite hard. Vesa.
Actually, I don't think there's one silver bullet here that you can choose.
Yeah, but you can shoot one anyway.
I should. Confidence is a good word to start with. I think that is precisely what we have to talk about. And then the question is, to what extent can we produce that through fiscal incentives? That is, in a way, that is what we have been talking about here when we have this 1 to 15 leverage in investment projects. And yes, we should use that to the extent we can, but there are severe constraints in many countries, including in our own country. So I don't think that we can bribe the private sector sufficiently enough to make investments. We don't have this fiscal base. We cannot give that sort of tax breaks. We cannot give that sort of subsidies, be it through this scheme or something else that would induce the companies to invest sufficiently. So then what you can do basically is regulation. The internal market is something what we can do in Europe, and then internally in every country that make it simpler and easier to comply with. Then a third element is something that I don't know if everybody likes here, but I would still emphasize. It's labor market reforms that makes it more attractive for the investors to recruit, which means that one would need to reduce the risks of recruitment, which is sometimes something that people don't like when they work. The capitalists have to find investment attractive enough for them to invest. And the final thing which I would then say is attitude, particularly in this country. We tend to, I mean, it's also always so easy for us to be pessimistic, negative. I think we get rewarded for that. I mean, the biggest politicians in this country have been basically those people who have been very pessimistic. And the biggest civil servants have been those people who have been very pessimistic. I think instead what we should do is to make these slush people, the entrepreneurs, young entrepreneurs, sort of heroes. And think like the Swedes do, like the Americans do, not like we have used to do.
Okay, so with great self-confidence and with a great attitude, let's give applause to our panel. And Mikko has still something to say as the last words.
As the last words, productivity has been mentioned a couple of times during the panel debate, and Kalevi Sorsa Foundation has really done its best this year to increase productivity, for example, in the form of books. We have published already 3 books this year. First, we started with Antti Alaja's report exactly on the entrepreneurial state, and I think this event actually grows out from this project, and I think this has created quite a lot of attention in Finland, and I think this is we have been dealing on the issues which are very much on the agenda, so I think this has been a very well spent time this afternoon. Our second publication, that was the green book, little green book. Then we have a bit bigger book, Blue and White, which deals with division lines in Finland, and we attack the questions of inequality on different fields, be it education or health, or between cities and rural areas, and so forward. And the little red book, which will be published tomorrow, actually, that tackles a question of aging society, elderly care, how shall we deal with this question in the coming years, when Finland actually is aging more rapidly than the Scandinavian countries or most of Europe. And I think this is an issue that has to do with our topic today. So this will be published tomorrow morning. Everybody who's awake at 9 o'clock in the morning, please come to Kirjasto 10, library number 10, where it happens. But like I said, I have enjoyed a lot this debate and these presentations today. I thank you all for participating, contributing, and for the public attending our seminar. And my last thanks goes directly to Antti Alaja and Giovanni, who's been that's been those who has been running this together. And this is another occasion of a good cooperation with the FEPS, which I always enjoy a lot. So thank you for this, and now I think we have done our day's work. Let's enjoy the evening. Thank you.
Not time well spent, time well invested. Yeah, thanks.